Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia. Today's session is in collaboration with Inter-Pacific Securities. So my name is Shaz and I am your moderator for today. So let me briefly introduce our speaker for today's session, Mr. David Lai Yun Hui. Mr. David is an analyst with 10 years of experience, currently attached with Inter-Pacific Securities, he covers small caps, consumer technology plantations, and also industrial product. So without further ado, please welcome Mr. David for his sharing session on equity market review and also outlook. So Mr. David Lai.
Hi, good afternoon, everyone. We shall begin. I'm going to share my screen. Okay. Everything's okay? All right. So we start off with a disclaimer. This is purely advice, not it's an investment advice, but not to buy or sell. We start off with the Malaysian economic outlook, where Malaysia's first quarter 2022 GDP has beat expectation, underpinned by the real opening of the economy. Similar to most countries that has reopened, the service sector experience was boosted by the retail and leisure services. Notably, we can see in the stock market where consumer stocks such as Korea and Genting, Berjaya Food and breweries has risen. The manufacturing sector growth has moderated, but it is still in a healthy mid-single digit growth, where the strong demand for E&D products cushion lower export for rubber glove exports. However, the agriculture saw a slowdown due to seasonality softness, while the construction sector is still remain in a contraction, but at an improved pace of recovery as worksite projects has accelerated. The mining sector was also in a contraction as several production facilities were undergoing maintenance. Good news is domestic demand continued to accelerate, driven by both consumption and investment. This is boosted by the private and the government demand. For our Malaysian exports, we continue to see strength in it, supported by the E&D segment, while the labor market has inched closer to pre-pandemic level of 3.4. The pre-pandemic level is about 3.4 to 3.6%. It has now improved to 4.1%. Previously, it was at a peak of 5.1%. Going forward into second quarter results, Malaysian economic outlook is set to recover at a faster pace on the premise on the expectation of easing of the pandemic condition in the absence of COVID lockdowns. For now, 2Q will continue to be supported by domestic spending in services and strong external demand for manufactured products. In light of the strong service demand, Bank Negara has also increased interest rate to help moderate domestic spending and also rent hikes. Rent hikes, I would say rent growth in fourth quarter was actually very positive, where the strong demand in the property sector has spurred growth. However, Malaysia do see us. We also like to highlight this point where Malaysia do see slower rate of inflation as compared to other countries due to our fuel prices are subsidized. This helps actually boost consumer spending. But in second half of 2022, with the higher interest rate and a strong dollar, this translates into higher input costs, which it will potentially moderate growth. Bank Negara has widely tipped off to lift interest rate another time this year, which we may see interest rate rise to 2.5% by the end of the year. This will result in tighter monetary condition. If the domestic fuel or energy prices rises, however, if it rises, we would see a spike in CPI rate. On the supply side, most of Malaysian companies has continued to see supply chain disruption, and also because of high input costs, it will actually dampen spending, because Malaysia heavily relies on import for most of our necessity goods. As we have seen in yesterday's news, the government has announced the abolishment of approved permit for food import. We have several discussions with several distributors in the FMCG segment. They are expecting at least 2 price hikes in second half. In light of this, despite these headwinds, Bank Negara is still keeping its full year's GDP estimate at 5.3 to 6.3%. Very strong growth targets in the ASEAN economy. Globally, other nations also seen cost pressure, which is no different compared to Malaysia, with commodity prices such as food, metal, petrochemical, and energy prices. It will result into further revision in GDP forecasts. As you can see, the oil and material prices has resulted into 0.5 to 0.8% cut in GDP forecast, and the impact will be more pronounced in second quarter, once we end second quarter. Furthermore, tighter monetary conditions could also temper growth prospects. Even if there is a quick resolution to Russia-Ukraine conflict this month, the changes in the supply chain route combined with sanction, all these input prices won't normalize anytime soon. Most listed companies have not gave guidance to the extent of on China's 1 month lockdown, but most of them has guided that their input costs will be profound in second half of 2022. Prior the start of the Russian-Ukraine conflict, most of the supply dynamics were already tight due to persistent bottlenecks. This also means the threat of stagflation remains high amid the high inflation rate. Will stay in second half of the year and could set some of the economic growth. However, the reopening of the most economic activities combined with high asset prices, which help elevate support the initial phase of consumer confidence in fourth quarter 2020 and first quarter 2021, have continued to see more consumer confidence, and this has placed most of the global economies at a growth trajectory. To reface the extent of the supply chain issue, Europe has a strong reliance on energy sources from Russia, and this will be the key driver for their inflation. The ongoing sanction will lead to shortages in fuel inventory, and high prices are already curbing some of the supply production as demand has slowed. The US economy is set to slow, but consensus reckon that it won't be derailed by the war. Amid sustained strength of its domestic economy, strong housing and job market is expected to cushion inflationary pressure. China's growth is set to moderate slightly, with the pandemic headwind affecting its major cities and manufacturing hubs. External risk has also risen, as with the inflationary pressure, also its property sector will remain in the state of flux. However, the government is hastening infrastructure and may cut interest rate to support its economy. From here, we will discuss more recent market sentiment in detail and how it has affected and how all these economic news flows has affected the markets. We start off with US as their market has the most influence in global equities. As we iterate, equity markets has been pressured by inflationary and also moderation in money velocity. De-inflation threatens earnings growth of many listed companies, and the slowdown in M2 money supply has pressured stock prices. The US GDP has contracted in 1Q, with most consensus pointed that sustained its recovery. The recovery is sustained. However, a handful of them thinks that this is a one-off recession if the Fed managed to curb prices without substantially cutting demand growth. Looking at the CPI data, most of the inflation has come off its peak. However, energy is just slightly off its high, which has actually helped moderate most of the CPI data in the United States. However, the strong demand in transport services such as domestic demand for airfare has jacked up the month-on-month CPI data. Going forward, most consensus expect CPI to soften, which will help ease the Fed hawkishness. But however, in the next slide, we see PPI has come off from its peak, but the time lag of the cost pass-through mechanism of input costs from higher commodity prices has not factored in. In short, the market is hoping for inflationary pressure to ease, but there's no clear signal yet. On the labor market, which is a sign of economic strength, the US labor participation rate is on an upward trajectory, but it has not surpassed pre-pandemic levels, indicating the labor market is still very strong and is increasing the inflationary effect. As we can see, averagely hourly wages is up 5.5% year on year. However, the month-on-month figures has moderated down to 0.3%. Some of the consensus reckon that the wage inflation is probably contained. However, if there is a runaway wage inflation, the Fed will have to further tighten its monetary policy. One of the key measurements that the Fed looks at for job strength is the number of job openings, which is still rising and is at a record high. The job quits is also at a record high. This shows that employees is still switching from their job position to different markets, and wage increase is still likely in the near term. Ideally, the Fed do wish to have a strong labor market, but at the same time, they want to curb inflationary pressure too. In this slide, we want to highlight that the asset prices plays a big role in consumer spending. Consumer spending right now is very strong. It's actually pulling prices higher, and in fourth quarter in 2020, most of the US companies has stated that they can pass down prices. So the asset prices which dominates in the US are mainly the US and the equity markets and the housing market. However, in this recent decade, there's a new asset class, crypto. This has actually elevated the asset value in the younger generation. As we look at into this month, we can see that equity, crypto, and the bond market has seen sizable price retracement. However, US house prices is still much still very high and is elevated. US house prices has not shown any sign of softness, and housing starts are still very strong. We also want to highlight that US household balance sheet has grew at the fastest pace in the past 50 years because of quantitative easing. And if the Fed really choose to tighten monetary policy, it has a lot of room to do so. Over in the EU, sentiment is not as bad as US, but because of the Russian invasion, it has actually turned down much lower, where most of the EU nation actually is reliant on Russia for their energy and also Ukraine for their food security. The French stock exchange has saw steep falls, while the DAX has also suffered quite a big loss as well. Similar to the US, the EU also see their number of job opening is still rising, and their job quits is also at a record high. In the early first quarter, the EU sentiment in the EU were lifted by strong service PMI, where most of it comes from tourism. But in last month, we actually see a dip in the PMI, where this actually shows that this inflationary pressure and also supply chain shocks has affected the growth of EU companies. But the service sector is still strong, which actually supporting the fall in the slowdown in manufacturing. However, despite all this inflation catalysts, the EU is actually very much in the expansionary phase, where the PMI data is still above 50. UK equities actually fare better than US and EU. This was actually mainly supported by their weaker sterling, where most of the UK firms, service firms, and also manufacturing, their receipts are in US dollar. Despite the Bank of England has raised its interest rate 3 times, the dollar has strengthened against the pound. Although PMI is still remain in a growth trajectory, the increase in input costs has limited the pace of expansion, as industrial production is in March and April. Business confidence dropped to 34, which is hammered by inflation. In such, most of the consensus actually highlighted that UK has a high risk of entering stagflation, where they see a drop in, where they will see the economy to contract at the same time their production supply to fall. In China, China equities has been on a downtrend, which has fallen even further because of COVID-19 outbreaks, which has forced lockdown in Shanghai and has tightened supply chain fears. The slowdown in China has also dampened commodity prices. However, the market is still in the dark whether these commodity prices will rebound once China reopens. And let's say if these commodity prices actually goes back to their previous high, most of the central bank will actually be very, very worried. Overall, Asian equities has outperformed most of the developed peers due to easing pandemic condition and also their commodity-centric economy. Asia firm also benefited from supply issue from the West as we recall, before COVID-19 started, there was actually the trade war, and most of the contractors for the West has actually moved their supply has in works moved part of their supply chain to ASEAN, and now most of the ASEAN tier 3 supply chain has also benefited from it. As you can see, Malaysia actually managed to buck the volatility trend and actually managed to gain 1.2% in the first quarter of 2022. Much of the gains were actually came from the plantation stocks, where the improved silver prices has actually elevated the KLCI, and the backdrop of higher interest rate has also saw uptick in the banking sector. In first quarter, despite the surge in oil prices, oil and gas stocks were still lagged, where fewer new contracts for most of the support service company were actually in the dark, because Petronas actually haven't really increased or rolled out their capex. As we highlighted, the KLCI were lifted. The KLCI outperformers were Science Darby and KLK Kepong, followed by Public Bank. The biggest loser were Top Glove, while also dragged down by the telecommunication sector. In the small cap, Thrift, Bonia, and Hexa has outperformed in the lower liners in first quarter, and the biggest loser were BASL Corp, Nationwide, and Gerasia. So if we run back in history, part of our equity market upside were due to firmer 4Q 2021 result, which were above expectation following the end of the lockdown measure. Market players also cast aside the imposition of windfall taxes on 2022 earnings that is not expected to derail corporate earnings recovery significantly, as most of the consensus for the banks for the financial stock is actually at a low digit PAT growth. Also, corporate fundamentals are tipped to stay healthy due to the buoyant domestic and external segments, which continue to attract foreign funds. Conditions in the broader market were also choppy as it began the year on a on a weaker note due to the negativity in potential rate hike. However, a pre-lunar New Year rally has allowed this lower liner and also broader market shares to regain some traction, but it was faltered again by the Russia invasion. Going into March, market showed some stability again from bargain hunting activities, but it was slowed down because of lingering inflation concern. Despite the recent pullback in global equities, valuations are mostly fair as they are trending largely within their historical forward PER averages of 14 to 16 times. Most of the developed indices are trading near their, actually trading -1, below 1 standard deviation of their 5-year average PER, with the exception of Nikkei. One of the reasons why valuations are this low is because earnings growth for this company are mainly still intact despite the inflationary pressure. Europe and Asia equity valuation remain the most attractive, partly reflecting slower earnings growth due to China lockdown and EU supply chain issue. As we want to highlight that China is still the factory of the world, and China slow down, ASEAN will also slow down. So in this chart, you can see the world MSCI index and also the S&P 500 has already traded below their five-year moving their 5-year PER average. In this chart, I want to highlight that the market breadth is falling in tandem with the stock indexes. As you can see, there is no divergence in market breadth and the indexes. Both of them are still making new lows. As I wish to highlight that we are still very far off from the COVID levels of, as you can see here in the, I can't see, okay. All right, you can see most of the stocks actually went below. Most of the stocks which were traded below 200-day moving average were actually below 20% during the pandemic crisis and also in the 2019 trade war. Right now, we are hovering at above 30, and let's say if the situation continues to worsen, the stock indexes in the US indexes still have room to fall further. So with uncertainties in the Eastern Europe and also inflation, which continue to see a sustained issue in the supply shortages, global equities are unlikely to climb, and the market conditions and all these unsettled market conditions are set to persist into the second quarter of 2022. As it is, the war is showing no sign of abating, but if it escalated or prolonged, global market could remain subdued for longer as the supply shortages would also linger that could disrupt many economic sectors and then corporate earnings performance. While the global market is reacting favorably to the Fed rate hikes in the beginning, but because of a more hawkish stance for steeper hikes to contain inflation, the global market continue to see selling pressure. The reduced liquidity from the tightening process could weigh on equities prices and also could spark exodus to less risky assets. Although the US is relatively insulated against the European geopolitical concern as they produce their own oil, it has not escaped the spillover effects, and its equity could still endure the significant volatility, mainly on inflation concern, which it has reached to a 40-year high. With the whisper of the impending recession or stagflation, which will further weigh down on market sentiments. Europe will continue to be most affected by the war due to its strong reliance on raw materials and energy sources from the two countries. ASEAN equities performance are likely to be patchy, with equities of countries emerging from from the pandemic continue to outperform. But North Asian equities may remain subdued as they will still be affected by lingering pandemic in China. On the positive side, COVID conditions have abated significantly in ASEAN, and many countries are already testing it as an endemic. This is allowing for more economies to return to pre-pandemic levels and will go a long way in restoring service-related industries that were in the brunt during the pandemic lockdowns. Still, the downside pressure will remain, and the market outlook is still very fluid. However, if the Russia-Ukraine conflict finds a resolution, a relief rally may emerge as the biggest as the biggest near-term market risk is lifted, but as we highlighted that the softening of commodity prices is still in the dark. Beyond the possible relief rally, supply concern will remain and could still dampen corporate earnings outlook for longer and leave markets choppy. For now, earnings growth to valuation are relatively reasonable, as we highlighted that the MSCI World Index is expected to grow 16% year-on-year in 2022, translating to a price earnings growth of 1.0. The S&P is set to post 18% increase in earnings year-on-year, which translates to a price earnings growth of 1.1, still reasonable, while European earnings is estimated to grow at 26% at a much cheaper price earnings growth of 2.5 times. However, it's much different in ASEAN, in Asia, where growth is expected to slow, to just come in at 2.5%, mainly due to the lockdowns in China. Despite reasonable valuation in certain parts of the world, and also deep discount in Europe, we still think that investors require a large discount before they jump in. With the Fed initiating tapering in June, further tightening monetary policy, market may have more room to retrace despite easing selling momentum. US machine accounts in value terms are 36% above pre-pandemic levels, but is 18% off its peak, as investors are waiting for a clear bottom and a sustainable rally to come before they actually take action. Bursa Malaysia near-term outlook could also remain choppy and will be dependent on overseas events to dictate its direction. The Fed's tapering, coupled with the supply shortages, remain the biggest market impediments. These concerns are keeping sentiments guarded for now and is likely to remain so over for the near to medium term, as inflation is far from softening. Foreign fund flow turned net sellers in the past few weeks amid bearish equity. This actually reversed their inflow course in fourth quarter 2022 and also first quarter 2022. Fourth quarter 2021 and also first quarter 2022. This also manifested in the continuing low to moderate participation rate that shows few signs of picking up, as domestic elites are still lacking. We believe it's mainly due to our EPF liquidating part of their portfolio to dish up what's it called here? The EPF 10,000 handouts. We also want to highlight that the lack of participation will prevent firmer follow-through buying and could also leave FBM KLCI to adrift in the absence of positive leads. With the broad market conditions are staying mostly subdued, there are still pockets of support, mainly from the foreign funds, which are still net buyers year to date. Their foreign buying support should prevent steep declines among the index heavyweights, whose prospects are also looking firmer as the country move into endemic phase of the pandemic. The move should also allow for increased in-person services, particularly spurring a revival in tourism-related industry that has been in the doldrums for 2 years. Also, export-oriented stocks in manufacturing and commodity sectors should also see ample support due to strong demand of their outputs. Therefore, the medium-term outlook appears much steady, that is helped by the country's easing pandemic condition that would bring stability into the country's economy and permitting the KLCI to find ample support at around 1,550 levels. Meanwhile, the 1,610 level is still a formidable hurdle, but if we clear, the FBM KLCI could target 1,650 to 1,680 levels. Similar to developed markets, Malaysian equity valuation are fair as they are lingering within the historical PER range of 14 to 16 times. The KLCI 12 months blended earnings growth is forecasted at 6.7% year on year, underpinned by the absence of Cukai Makmur in year 2023 and also higher CPO prices in the second half of the year. The broader ERMAS index should post a 20% increase in earning. The broader ERMAS index blended earnings growth is expected to be around 11%. I mean, the ERMAS index should post 20% earnings growth, which is revised higher as compared to the previous round at around 11%, due to the reopening of the borders and economy. As you can see, the KLCI is traded pretty much below the 5-year average price earning ratio average of 18.5 times. At the lower liners, the broader market shares have managed to regain some ground in March 2022, following the downward streak that started in November last year after the government introduced high stock transaction stamp duty. There should be support on some sector leaders over the near to medium term, riding on firmer recovery theme on technology, which is mainly EV related, energy, plantation, and consumer stock, which will help swim through this volatility and keep markets afloat. However, after a strong recovery over the past month, condition has turned toppish, and with a few compelling buying impetus left, lower liners looks to undergo a near-term consolidation. As it is, interest on these stocks, as measured by their traded volume, remain mostly on the lower to moderate side. In view of this, it could remain difficult for lower liners and broader market shares to make significant headway over the near to medium term. The selling pressure is also light of the time being to allow most of these stocks to stay stable for longer. So with the strategy going forward, with global central banks dominating index trend with their aggressive withdrawal of monetary policy, we strongly advise to not be aggressive on stock selection, especially for trading due to unsettled market conditions. However, those who choose to trade should focus on laggard firms with fundamentals and also earnings growth visibility that will ride out ongoing market choppiness, in particularly for export-oriented stocks, which are surrounding the EMS and technology sector. Taking a longer-term view, sector leaders are possible for a recovery in third Q and fourth quarter onwards, as we can see with the improvement with the intake of foreign labor. We could see this will actually support the export-oriented stocks, and stocks like banking, energy, gaming, and also hospitality stocks should continue their momentum. We also advise to include high dividend paying stocks to add resilience to the portfolio. So you can see the FVM KLCI has break through the rising wedge, and it has found support at the 1,550 levels. Similar to small cap, it has rebounded strongly in March after bargain hunting. It has found some support recently due to our reopening of our economy and also getting off of the endemic phase. The finance sector continued to trend higher, but in the near term, it has shown some bearish divergence in the MACD level. In the plantation sector, unfortunately, it has formed a double top. If it could not break out from this record high, if the plantation sector how shall I put this? The plantation sector has seen a double top and is showing some selling weakness. We do really advise to be precaution in plantation stock. However, we could not rule out the possibility of CUPO prices to stay elevated, because in the supply and demand for vegetable oil, this is still very much going to be very tight for the next 3 years, as new planting for palm oil for the past 5 years has been very much less due to regulations and also low CPO prices. So we do expect CPO prices to maintain above 4,000 ringgit per ton, but technically it does not look that strong. For the energy sector, however, it actually shows very strong momentum, where the bullish momentum still continues, and it has broke up from its previous resistance in February 2022. In technology, it's very interesting, mainly because it has formed a double bottom, despite the SOX index in US and also the Nasdaq has actually continued to fall further, but technology stock has found a strong footing. So this shows that selling pressure has much elevated, but we advise that allow the technology sector to form a proper bottom before entering. So from here, we end our presentation, and back to you, Sas.
Hello, thank you so much, Debbie Light, for your sharing session. So now we will proceed to Q&A session. So if you guys have any question for our speaker today, you may type your question in the Q&A box. Okay, there is one question from Feng Yi Wong. When is the right time to enter the technology stock?
We believe once in third quarter, where inflation start to come off, or we can see a clear sign of softening of inflation, then that would be the right time to actually not to enter, but to consider. The real time to entry for technology stock is when we see the Fed actually step off its gas from tapering, because because how should I put this? High interest rate actually has a dampening effect on growth stock, and once there's a slowdown in interest rate hike, or once they are able to control inflation, then that would actually show a bottom in technology stock. As we all know, our technology sector is in the forefront of growth for the next decade due to 5G, EV, and cloud computing. This will definitely see the fundamentals are there for technology stock. Right now, it's just being beaten up because of high interest rate. I just want to highlight that this year it's better to focus on EV-related technology stocks, because as announced from Nikkei News last night, where most of the China phone owners like Oppo, Xiaomi, they have all reported they will cut their earnings, not say earnings, their sales revenue by 20% at the moment because of the lockdown in China, which has actually dampened consumer spending.
Okay, for the next question, from Jane Cam, may we know that what is your top 5 stock pick?
I'll start off with the one that recently came off very positive, which is Pentamaster. Mainly, despite the supply chain issue in China, they actually managed to develop orders for their test handler machine for the power modules in the EV sector, and combined with growing prospect for their medical segment, where a very huge MNC company in America has actually invested their plant in Penang, in Batu Kawan, and is expected to commence in second half of 2022. And all this factory automation, Pentamaster is actually one of the beneficiary of it. So I would say one of my top stock pick in my coverage would be Pentamaster.
Okay, for next question from Stephen Patrick. What is your view on capital A now that flying restriction have been removed?
I do not cover the aviation sector, so I wouldn't be able to comment on that. The aviation sector, of course, if they are able to pass down the increase in fuel costs and continue to see good loading volume in their in their air flights, definitely you will see improve in earning prospect. However, I do not cover in depth, or I do not look at capital A, as I am aware of they have very high gearing issue, which high interest rate would affect them.
Okay. Next question from Michael Ng. What would house year end target for KLCI?
I'll get back to you with that. I need to check back my in-house notes for target for the KLCI. I'll reply that later.
All right. Okay. Or Michael Ng can email to you. Is possible? Did you have any email to give it to the participant to email to you?
You mean my email?
Yeah. Because
okay,
right
yeah.
after the yeah.
Where should I type it in?
In the chat box.
Okay.
All right. Michael Ng, you can email to David Lai. So David Lai will answer your questions.
I'll also send my email to Kao Lishi as well.
Okay. Okay, next question from Tony Koch. Is it time to pick up a gaming stock such as Genting Berhad or Genting Malaysia?
I'll start off in two perspectives for the gaming stock in Malaysia. Yes, the gaming stock has actually shown their price are very well supported despite the sell down in the global market and also in our Bursa Malaysia, which actually show a sign of strength. So this is not a trading advice or any, but given that the stock has actually shown significant strength despite the sell down, maybe when the market improves, Genting is poised to also move up higher as well, much faster than the rest of the peers.
Okay.
As with the same practical outlook for Genting, at this time of bearish market, if there are stocks which are showing divergence in a way that there is a sell down, but the stock didn't fall much or maintain its prices or continue to climb, this show very strong sign of strength. And I guess there's stronger opportunities to actually make a profitable trade from this kind of stocks.
Okay, thank you, David Lai. So next, question from Ari Chantran. Ari, okay, from Arila. Why is Valestro down so low when oil is so up?
Valestro is not one of this is my own perspective. Valestro is not one of the, I would say, fan favorite for stock traders.
Okay. The other question from Hong Chao. What's your outlook on aluminium and also steel material sector?
I would say most of the consensus are actually still bullish on the aluminum and steel sector, mainly because of the fundamental change in the production processes due to green energy and also carbon taxes in China. Hence, aluminum prices has actually came off from the high, and we can see that very clearly in last month and also this month. However, most people are in the dark whether if China really can come back and the government really do support their housing market in a way that there is further development in aluminium. It's poised to see aluminium prices to rebound back to the previous high. But then again, I just want to say aluminium price, even at this price level, is still much higher than the pre-pandemic level due to the shortages of demand. Given that we are trading in the equity market where commodity prices also dictate equity prices, most traders will actually want to sell off at every peak, because in past history, commodity prices,
Okay.
most fund managers do want to take profit when commodity prices reach the new high. And for the previous question on the KLCI, our year-end target is 1580 to 1600.
15,000. Okay, next question from Fung Yi again. Which technology stock can better weather the inflation?
I personally like Pentamaster the most, due to its diversification as compared to other tech-related stocks. Vitrox is mainly on the EMS, and also they are now actually venturing into front-end wafer inspection, or I would say highly advanced manufacturing process for wafer inspection. They are still very much concentrated in that segment, whereas compared to Pentamaster, they are actually in high-end computing, automation, medical devices, at the same time auto testing for automotive EV segment. So Pentamaster has also do have a very strong balance sheet, as they have very high cash level in hand. Other stocks like DNEX, yes, they will definitely benefit from the near-term shortages on foundry capacity, but we are not sure about whether they can really execute or not, because execution is also a key risk. We can see Pentamaster is the forefront in diversification, in improving their customer base. As Inari, they have also started 2 years ago, where they had their big private placement to venture into material processes. Yeah, so, and if we want to look at Great Tech, yeah, in the recent Great Tech result, we also learned that Great Tech is also looking into diversification. So we advise to cushion this earnings volatility period, a well-diversified company is actually the best.
All right. Kolishi, we have a question from Kolishi. Today, do we Inter-Pacific have a promotion on account free CDS opening?
No, we don't. No, we don't.
Yeah, so unfortunately, Kolishi, so sorry, today we don't have the promotions, but we have another question from Ari. What is your opinion about gold stock? When is the right time to enter the gold stock?
Gold stock is best to enter when the Fed, I would say the central bank start to ease. Let me have some water first. Yeah, I wish to further clarify this question. As you can see, the strength of the dollar actually affects a lot of commodity prices. When the ringgit start to weaken, actually it's not only the ringgit, many other currency also start to weaken. And the strong dollar actually affects a lot of the commodity prices, which actually will bring it down it's off its peak. So when it's time to buy gold, it's actually when we have a very weak, going to have a weak dollar. So when the dollar starts to weaken, it's the more appropriate time to get gold. As you can see, gold and silver has actually come off. How much is it now? I think it's 1,800 plus.
1,800 plus. Okay. So we have reached the end of our Q&A sessions. So I would like to say thank you to all participants for actively engaging with the speaker, and also Mr. David Lai, thank you for your sharing session, and it's very insightful. For more inquiry, you can email to our speaker, which is research@interpac.com.my. Is it correct, Mr. David?
Yes, it is.
Okay. All right. Thank you so much, everyone. Thanks to those who are joining us. See you again for our next session. All right. Thank you, Mr. David. Bye.